just start out by saying, for a lot of people, the recent strength in the housing market had been encouraging. The home builder stocks are rallying. Now there seems to be some worry that's being snuffed out a little.
Yeah, and that was started at the beginning of this year because rates actually dropped back a little bit in the 6% range, and people came flooding back into the market for the spring. There was more inventory coming on, and home prices had also bottomed out in January, so people thought, okay, it's more reasonable. Then when we got that 8 handle on the 30-year fix, and you talk about the difference between a 3% and an 8% rate, you're talking $1,000 difference on the monthly payment of a $400,000 home.
Mark, it was striking, though, to hear Paul McCulley make the point last segment that it's almost as if homeowners are living in a giant rent-controlled apartment because most of them locked in super low mortgages for the life of that mortgage. The joke in my neighborhood is no one's ever moving, and so they have not directly been hit yet.
Yeah, no, absolutely. I mean, I think the average interest rate on existing mortgages is about 3.5%. So that's, obviously pretty low. A lot of homeowners were very aggressive in refinancing down their mortgages when interest rates were at rock bottom. And so they're sitting in a pretty good spot, right now. I do think, though, over time, people have to move, right? Life happens. You've got job change, you've got children, you've got divorce, you have death. And I think we have a lot of pent-up life out there. People aren't moving, even though increasingly the home they live in isn't exactly what they need. It's not consistent with they're changing their living circumstances. So they'll have to move. And once they start to move at these mortgage rates, even if they come down a little bit, I do think we'll see some house price declines. And we've been fortunate so far. House prices, as Diana mentioned, have not fallen significantly nationwide, but I think that's ultimately going to happen.
Diana, under normal circumstances, one would kind of think, wouldn't one, that as interest rates rise, prices would stabilize or even fall to compensate for the higher payment.
Which is historically how it works.
Which is historically how it works. Why not this time?
Supply. Lack of supply. This is just a crazy, strange housing market, and I hate to get too, clinical on you for it, but in most markets you see that happen. But we not only were underbuilding well before the pandemic because of the Great Recession, builders still weren't up to their normal historical levels of production. Then the pandemic hits and everybody wants to move, everyone wants to buy, and you're buying with a 3% mortgage rate. So let's all get in on home ownership. And then you have even less supply. There was nothing else to do but go buy a home. It was
pandemic. I was stuck in my home. I might as well have a better home.
But I would also add, I'm curious for Mark, because he talks about people have to move, but we're seeing a lot of people now who are selling their homes and renting single-family homes. That single-family rental market is just taking off. Mark, do you think that that's going to be, a product of this? People who say, okay, I have to sell, but I don't want to buy at an 8% rate?
Yeah, that's a strategy, Diana, but I don't think that's for most people. I mean, that takes a lot of energy.
The builders think it is.
What's that?
The builders think it is. Build for rent is huge right now.
Oh, yeah, well, in the grand scheme of things, it's pretty small, right? I mean, in terms of the percent of the housing stock, it's still pretty small. But you're right. I mean, that's one of the amazing things. Builders, others in the industry, and homeowners are incredibly creative, and they'll try to figure out ways around actually having to drop price. But take the builders, they actually have dropped price, right? I mean, one of the ways they've kept their sales up relative to the existing market is the interest rate buy downs, which is effectively a price cut. So they have effectively cut price, and that's one reason why they've been able to keep sales up as high as they've been able to keep up. But at the end of the day, I don't think people renting their homes is going to be is going to stop the house price declines that will ultimately have to come.
So let me ask both of you this. I'll start with you, Mark. What is the interest rate at which sellers will start to say, I'm ready to move, I'm going to put my house on the market, in which more supply comes on and buyers get motivated? What is that rate, and when might we get there?
6%. I mean, I think that feels like the kind of threshold. We've had a natural experiment here over the last 6, 12, 18 months. Interest rates have gone, they got up to 7, they went back down to 6, now we're at 8, and you can feel it in the marketplace. Once you get down to 6, a little bit south of 6, the life comes back into the housing market, people start to move, activity starts to pick up, home sales begin to happen, and I think that's the kind of the number we need to see. And in the long run, abstracting from, the business cycle, in the long run, fixed mortgage rates should be somewhere between 5.5% and 6%. That's kind of where we should expect them to be.
What's your over-under on this? What's your over-under on this?
Okay.
I'd go lower than 6.
Okay, so I'm going one lower. Sorry, Mark. John Burns from John Burns Real Estate Consulting, who covers the buildings, he says it's the 5% range, 5.5%. And coincidentally, that's where the builders are buying the rates down to. They're buying down to 5.5%. That's where buyers are getting in. So I think they need a little more than 6%, especially because home prices are still rising, up 2.6% year over year.